Investing is risky business. Got a lot of questions from one of my previous videos about the difference between Morningstar risk and investment risk. Let's talk about a couple of the terms that are involved, and keep in mind, normally you have to take great risk to make great rewards. But let's just talk about real estate first, because we've been talking about real estate investing. I think you need to know the term cap rate. Cap rate means the amount of expected yield you get, the capitalization rate for a piece of real estate. That means that you take the net operating income and divide it by the value of the property. I'm going to give you an example right now of how you get to a cap rate. Let's say you invest $500,000, you buy a piece of real estate. That's the numerator, right? There's the numerator and denominator, right? And let's say that real estate has a $30,000 net operating income, NOI. That's a 6% cap rate. That is considered very conservative real estate, very conservative. More aggressive investors are looking for about an 8 or 9 or 10% cap rate. In fact, with real estate, if you purchase a piece of real estate and it's an investment property and you have a 10% cap rate, that is generally regarded as pretty high risk investing. So here's our example again. Let's just say that you purchase a piece of property for $500,000, but it produces $50,000 of net operating income to you. That's a 10% cap rate, and that's considered high risk. Now, with passive investing, you can put money into investment management funds that other people own, whether it's REITs, master limited partnerships, ETFs, mutual funds, and there's a company called Morningstar, which you can go to and look up, and they have a risk rating for each one of these. Now, I want to tell you that certain investment funds, and I've been happy to profile the JP Morgan Income Fund, and that's an investment fund that uses a strategy called covered calls, and it has about a 9% income payout. Now, Morningstar rates that as a moderate income investment. So even though it's very close to what the cap rate would be on something super aggressive, the JP Morgan, let's just give you the quote again, JEPI. The JP Morgan, JEPI is actually a moderate risk investment. You can plunk a bunch of money in there, and again, you don't have to deal with tenants, you don't have to deal with property taxes, rising insurance rates, house repairs. Now, you give up the appreciation on a piece of real estate, but if you're investing primarily for income, right? Morningstar compares investments against all of the investments in their peer group. And here's a really good judge for JEPI. For those of you who invest in index funds, and I do too, JEPI has about half the risk of the S&P 500. According to Morningstar, they judged risk by a thing called standard deviation over 3, 5, and 10 years. It's a little bit complex, but don't worry about it too much. The Vanguard Index 500, the S&P 500, has a standard deviation of about -20. That means, over that period of time, it can go down 20%, okay? The JEPI has a standard deviation of half of that, about 12%. So, it's half the risk of the market and produces great income. That's definitely a moderate investment. So for those of you that are converting from being a growth investor, those are the people in my first book, right? Smart Financial Wealth Builders. You should be investing in the most aggressive, the most growthy things, and that would be the Vanguard Index 500. The VOO, right, or the SPX, you should be buying those. And then you get to middle age. Maybe you're someone who read my second book on smart financial longevity planning, and now you're building a balanced portfolio, and you're thinking more about being a little safe and protected. Okay, well, that's when you start to add fixed income things to your portfolio. However, if you're in the Boomer catalog, my third book, and you want to convert from asset building to income, converting assets to income, JEPI is the kind of investment that can take your $1 million growthy portfolio and turn it into a $90,000 a year income portfolio. For more information on converting assets to income, transitioning from being a growth investor to an income investor, follow along by clicking on the link in the caption below, subscribe, listen to our podcast, And staying up to date on how you can convert your portfolio to your category in life is just part of the art of being smart.